Yeah, if you think of it, if you think of most asset prices versus this debasement, the S&P is doing about 8% a year since 2012, which basically just keeps your head above water. The Nasdaq's done about 17%, but Bitcoin's been doing 150%. And when you look at Nasdaq versus Bitcoin, the Nasdaq is down 99.97%. So it does do very good for your purchasing power, but this debasement is a real issue because most things just don't keep up with the debasement. So you're right. We're not going to have a massive debt blow up. What we're going to have is this ongoing bleeding of all of our purchasing power.
In a recent interview from Wealthion, we gain insight into Raoul Pal's perspective on the current market trends, including why markets are declining and the factors behind the strength of the US dollar. Pal also explores the effects of currency debasement and Bitcoin's role in this changing environment. During this discussion, Bitcoin was trading at approximately $59,000, showing a 1% decrease in the last 24 hours but an 8% increase over the past 7 days, with a total supply of 19.74%.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
So the volumes in ETFs are driven by two: net inflows, or people known as arbitrageurs who are arbitraging the futures market. So we don't know what that flow was. So they would sell the futures, which trade at a premium, and then buy the ETF. We don't know what that flow was, but let's assume it's net inflows because Binance saw record inflows yesterday as well. So what we're seeing is people, I think, because of the education that you've been doing, I've been doing, Michael Saylor's been doing, everybody's been doing, people are starting to understand the game. And even Larry Fink has been explaining the game. The game is the erosion of your purchasing power, not via traditional CPI inflation, but via this more pernicious debasement idea. And I think people are understanding and have been educated that this is a volatile asset class. And, as I started at the beginning of the show, is if we do get sell-offs, people are starting to realize that's when I buy. That same strategy worked incredibly well in the NASDAQ over the years as well. You've got a big secular trend, any wobbles, generally a buying opportunity. When you invest in the crypto asset class, you expect volatility. If I go back over all the years I've invested, most years you get 2, 3, or even 4 30% drawdowns. This one in Bitcoin has been 27%. It's kind of within the range of normality. And what you need to ask yourself is the main drivers of crypto are the business cycle, i.e. where are we with the economy? Well, we're starting to pick up slowly. Inflation's coming down. Rates are going to come down. Liquidity is going to come in. And so therefore, that's usually a very good time for crypto. So the tailwind is behind you. And the other thing, are people adopting the technology? Are things being built on it? And that's ongoing too. So when you see a news event like the last few days, driven by macro factors, you tend to think they're likely to be short term. Now, if the business cycle was getting old and the economy was starting to feel a bit more fragile, then yes, you might be worried about it. But this is early in the cycle, and generally you have to expect the volatility. And how I've always dealt with it is a Jedi mind trick, which is you look forward to it. When it happens, you can buy more, and you get to compound your returns much better than anybody else who just does nothing or tries to trade around it. So you should be thinking of these sell-offs as a gift. Is, oh, wow, if I can find a bit more cash, I can put it into the market. And you tend to do really well over the cycle by doing that strategy. So it's generally not the change of interest rates. Nobody really cares if your rate goes from 10 basis points to 25 basis points or whatever, right? What it actually was the move in the yen, because you have to pay back, you're borrowing yen. When the yen starts moving a lot, then that starts concerning you. The yen went up a lot. So suddenly the amount of yen you've borrowed has gone up in dollar terms. So what happens is everybody reduces risk. And that was the real thing, is the Bank of Japan started intervening in the currency market because their currency was too weak. And they started selling dollars and buying their own currency. That's what everybody borrowing yen went, oh my God, now suddenly, yes, I'm getting a cheap pickup in borrow, but bloody dollar yen is moving 2% a day every single day, and I'm losing a lot of money. And what happens is a risk manager comes along at a bank or a hedge fund and goes, you need to close your positions or reduce your risk. And that's really what the last 4 days were all about, was the risk manager tapping somebody on the shoulder saying, listen, you're losing money on this side. You need to start reducing risk. And that's why everything gets hit, from crypto to NASDAQ to mining stocks to oil to anything, any risk at all. But these tend to be very short-lived because, once the market resettles, they get used to the change. People have been washed out of positions. It then kind of settles back to normalcy. And these, I call them macro spasms. They don't usually last very long. Could it last a week? Could it last 2 or 3? That's possible. 2016 saw very similar. The dollar had been very high. The world economy was super slow. World trade had slowed down because the dollar was so strong. And the Japanese came in and intervened in their currency. All the markets blew up. Exactly the same mechanism. But what happened after that was the central bank started stimulating, particularly the Chinese, because they've been waiting for this moment to do so. The Europeans last time around and the UK last time around. This time, I think it's going to be the Chinese who are going to stimulate. And why they get to stimulate is they couldn't do much cutting of interest rates or stimulating of monetary policy because their currency was too weak and they didn't want to lose control of it. But now the dollar has weakened, they're able to do more. So I think really it's probably a net positive. Just give it a few weeks and it's probably very positive.
As we just heard, Raoul Pal shares his views on the current market, emphasizing the relationship between the US dollar and Bitcoin. He highlights Bitcoin's potential as a hedge against currency debasement, and explains the significance of understanding liquidity flows and their influence on future market trends, especially for cryptocurrencies. Pal argues that as central banks lower rates and increase liquidity, it creates a favorable environment for Bitcoin and other digital assets. This perspective offers a deeper insight into how Bitcoin can serve as a stabilizing force during economic uncertainty. Now, let's hear more from Raoul Pal on Bitcoin's transformative potential in today's market.
I think all of these big blockchains will be worth multiple trillions of dollars because these are not single applications. They're entire networks of which you can build entire other businesses upon. These are immensely valuable things, but the applications haven't yet been built on it. So yeah, I think you're dead right. This cycle is not where these things are going. I think this space goes from 2 trillion today to 100 trillion by 2032, 2034. I want to go back to what I just said. $2 trillion to $100 trillion in, let's say, 10 years. That will be the largest, fastest accumulation of wealth in all of human history.
Yeah.
That will be double the 100-year accumulation of wealth of the S&P 500.
Yeah.
So therefore, as an investor, that's the thing to keep in mind. How do I stay in this trade for as long as possible and compound what is the largest? If I go back to anybody and say, would you have bought the NASDAQ in 1990? Everyone would, hell yes. Well, here you've got it, 1990, not 99, 1990. You go, hell yes. Well, that's where we are now, somewhere in the mid-90s of the NASDAQ. Just think about the amount of wealth that generated from the technology boom. This is going to dwarf that. I actually think it's a bit of a red herring because the US dollar is the world's reserve currency. The US doesn't need to hold other assets in reserve. Yes, it's got gold, but that was a legacy from leaving the gold standard. Other countries have to have reserves to support their own currencies, so they don't need it. Now, would they do it? I think it sounds flashy. For what reason, I don't really know. But let's assume that they do. Let's say I'm wrong and they do build something. It's kind of a weird world because, yes, obviously it's good for the crypto market because there's yet another buyer. But it's also weird because Bitcoin was set up to try and replace the government's control over money. And now you're inserting the government as one of the largest buyers of private money. I don't really like that, actually. But it's probably net positive for the crypto price. Now, maybe it pushes private use of money away from Bitcoin if that were the case. Because if the government can manipulate it, they could dump it onto the market, they can buy more, and before you know it, they're using it like they are interest rates and controlling regular money, and we don't want that.
Raoul Pal offers an in-depth analysis of market dynamics, highlighting Bitcoin's role as a hedge against currency debasement, and the impact of liquidity flows. We'd love to hear your opinions on a few questions. What do you think about Bitcoin's potential in the current financial landscape? How do you view the impact of the US dollar's strength on global markets? For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.